All right, so the independence of the Federal Reserve. It's supposed to be this, bedrock of our whole economic system, right? A shield against political meddling. But here's the thing. That shield is getting some serious cracks. So the big questions are, is the Fed really independent anymore? And maybe more importantly for us, how does this whole tug of war affect your wallet? Let's get into it.
You know, this quote from a former Fed chair is just perfect. It gets right to the heart of the problem. Think of the economy as a big party. Politicians, they always want that party to keep going, right? Especially with an election around the corner. But the Fed? Well, the Fed is the chaperone, and its job is to take away that punch bowl of easy money before everyone gets way too carried away and inflation ruins everything.
So to really unpack all of this, here's how we're going to break it down. We'll look at that punch bowl problem, the idea of an independent chaperone, the history of political pressure, the cracks we're seeing today, and then the big one, what it means for your portfolio and what the Fed's future might look like.
Okay, let's kick things off with that fundamental conflict, the classic battle between what feels good in the short term politically and what's actually healthy for the economy in the long run.
Yeah, economists have a name for it. This is called the time inconsistency problem. It sounds complicated, but it's pretty simple. Governments are always tempted to push for lower interest rates. It juices the economy, makes voters happy, you get the picture. The catch is that it can also light a fire under inflation later on. So having an independent central bank is supposed to be the fix for that very human temptation.
So how is the Fed actually set up to be this independent chaperone? How is it designed to say no to all that political pressure?
Well, the Fed's independence didn't just happen overnight. It was really forged over decades, usually after some kind of crisis. It got started back in 1913, then it got more power in 35, but the absolute game changer was the 1951 Treasury-Fed Accord. That was the moment the Fed basically said to the Treasury, we're not just here to print money for you anymore. It was a formal separation that gave it real freedom.
And you can see how this independence is literally built into its DNA. Governors get these super long 14-year terms so they can outlast any president. The Fed funds itself. That's huge, so Congress can't hold its budget hostage. The chair's term is staggered so it doesn't line up with elections. And maybe the most interesting part? The regional Fed presidents who get to vote on interest rates, they aren't even picked by politicians.
But here's the thing. Even with that brilliant design, history shows us that independence has never really been a sure thing. It's always been a fight.
Just look at the data. I mean, this is wild. This chart shows how many times presidents met with Fed officials. Richard Nixon, 160 times in 6 years. 160. Now compare that to Bill Clinton, just 6 times in 8 years. This isn't just about different communication styles. This is a pretty clear signal of how intense the political heat can get.
And if you want the smoking gun, here it is. This quote from the diary of Fed Chair Arthur Burns spells it out. He felt immense pressure to pump up the economy to help Nixon get reelected. This wasn't just a friendly suggestion. It was a political arm twist that a lot of people now blame for kicking off the terrible inflation of the 1970s.
Okay, so let's fast forward to today, because that pressure hasn't gone away. In fact, you could argue the very idea of an independent Fed is being attacked from all angles.
Which leads us to the billion-dollar question for our time, right? After all this history, all these political fights, is the Fed structure still strong enough to guarantee its independence today, in the real world?
And here's the uncomfortable truth. At the end of the day, the Fed is a creature of Congress. That's a direct quote. It means Congress created it, and Congress can change it. They can rewrite the rules anytime they want. And that, right there, is the ultimate political trump card.
And the challenges today are everywhere. You've got politicians on both the left and the right openly yelling at the Fed. The Fed itself has stepped into new roles, like deciding who gets credit, which is a very political thing to do. There's a revolving door, between the White House and the Fed's top jobs, which makes you wonder about influence. And get this, that 2% inflation target we hear about constantly, the Fed just kind of picked that number itself. Congress never actually signed off on it, which raises all sorts of questions.
Okay, so this is where the rubber really meets the road. This isn't just some high-level debate for economists. This stuff has real tangible consequences for the market, for the economy, and yeah, for your portfolio. This is why you need to be paying attention.
Let me be crystal clear here. The entire financial system, more or less, runs on one thing: Fed credibility. It's the belief that the Fed will do what needs to be done to fight inflation, no matter how much political screaming there is. The second the market stops believing that, the whole house of cards can start to wobble.
So what does that wobble look like in the worst-case scenario? Well, an analysis from MSCI ran the numbers. If the Fed loses that credibility and we get hit with stagflation, that's high inflation and slow growth at the same time, a typical global multi-asset portfolio could get crushed, losing around 11%.
And this chart really spells it out. Look at the three possible futures here. The first bar, that's stagflation. Fed credibility is gone. Boom, you're looking at a painful minus 11% return. The middle bar, that's a more normal recession where people still trust the Fed. It's a loss, but a more manageable minus 5%. But that last bar, the soft landing, a 4% gain, that's the dream. And it is only possible if the market has total unwavering faith that the Fed can land the plane.
So with all these pressures, all these modern challenges, people are starting to ask, is the Fed's current setup really built for the 21st century? Or does it need a major overhaul?
Now, one really fascinating proposal out there is something called monetary federalism. It's a pretty radical shakeup. The idea is to make the Fed's main board in D.C. more accountable to the president. But, and this is the key, you'd also give way more power to the regional Fed banks. State governors would pick their boards, and all those regional presidents will get a permanent vote on interest rates. It's an attempt to create a whole new system of checks and balances.
And that really leaves us with the question that will define the next decade for the economy. The whole system was built on the idea of having that sober chaperone watching the party. But in this hyper-political world, what happens if the politicians finally get their way, fire the chaperone, and decide to spike the punch bowl themselves? And as always, just a reminder, this is not financial advice.